Mark Yusko, founder of Morgan Creek Capital Management, has put forth a simple framework for portfolio management. He has suggested investors consider dividing their capital into 3 buckets: one for current expenses, one to stay rich, and one to get rich. Here is an excerpt from Mark's appearance on the Meb Faber show, in which he discusses this approach.
And you've got your liquidity bucket, and that is to fund the next 2 years of spending. So it should be 10 to 15%. That 10 to 15% should be in truly liquid, cash-like, bond-like, very low-risk things, because you're going to need it to spend. And if you spend 5%, 2 years is 10. If you spend 7% a year, then 2 years is 14. So round to 15. So 10 to 15% in the liquidity bucket. Then I say everybody should also have a get-rich bucket. Now, the get-rich bucket, I tell people that should be to own pieces of businesses. It should be, income real estate or whatever. But really what people do with that, it's their punting money, right? It's the hot stock tip from their broker. It's the thing they hear on CNBC. God forbid it's the friend's, condo deal or other friends' venture deal. And I would say you're going to lose all that. So just keep it small. So 10 to 15%, play money. Be willing to lose it, and if you hit a big home run, fantastic. If you focus on it and you really spend time on it, it can be incredibly productive. So that get-rich bucket has a hole in the bottom, and it drips down into the middle, which is the biggest bucket, 70 to 80%, which is the stay-rich bucket. And that stay-rich bucket then has a hole on one side of it, and it drips down into the liquidity bucket. So every year you take 5 to 7% out of the stay-rich bucket, replenish the liquidity bucket, and hope the get-rich bucket generates some good stuff. But in that stay-rich bucket, that's where it's all about diversification. Because getting rich is all about concentration. Every large fortune in the world, right, came from a concentrated position, concentrated stock position.
Investments targeting 100 baggers would be in the get-rich part of the portfolio. Remember, this is a small part of one's overall portfolio. Yusko recommends 10 to 15% for getting rich, and 100 baggers may only be one part of that. The get-rich bucket benefits from taking advantage of 2 key concepts that assist in wealth accumulation. First is a long-term outlook. Research has shown that investments that take more time tend to offer a higher annualized return on average. 100 baggers certainly fit in this category. Second is a concentrated portfolio. Concentration increases the potential for high returns as well as high losses, so it should be done carefully and only with capital that can tolerate that risk. 6 Jupiter's 100 Bagger service helps you build a portion of your get-rich portfolio that follows these 2 concepts. Our monthly emails give you up to 3 stocks our artificial intelligence has detected as having 100 bagger potential. In many instances, the recommendations will be the same from month to month. For those operating on a monthly budget, this is an indication to continue building a position in those stocks. A portion of the email is also dedicated to stocks that were once on the 100 bagger trajectory but have since wandered off and thus may warrant being sold. To learn more and to get started, visit 6jupiter.com.